After much anticipation, Canada's 2025 federal budget was presented on November 4th. Titled Canada Strong, this year's budget emphasizes long-term capital investment over routine operating spending. The focus? Clean energy, critical minerals, housing, innovation, and national security. The budget was put forward as having a goal to reduce uncertainty and boost competitiveness for Canadian businesses. It introduced a few tax measures aimed at this, but on balance, this does not seem to be the focus of the measures. So let's dive in. First up is transfer pricing. The budget modernizes Canada's rules starting for taxation years after November 4th, 2025. These changes align with OECD arm's length principles and international standards. But what does that mean for businesses? Expect a more aggressive CRA with these new measures. Also, the deadline to provide transfer pricing documentation will shrink from 90 days to just 30 days after a CRA request. So you need to be ready versus get ready after being asked. Next, stimulating innovation. The Scientific Research and Experimental Development Program's enhanced 35% tax credit limit increases from $4.5 million to $6 million for taxation years beginning on or after December 16, 2024. By making more spending eligible for the enhanced credit, companies have a stronger incentive to invest in research and development, which can drive productivity and competitiveness. If you spend $6 million, you can get back 35% of it, which triggers investment and creates jobs. Budget 2025 also introduces a temporary 100% deduction for eligible manufacturing and processing buildings. This includes additions or alterations provided at least 90% of the space is used for manufacturing. The measure applies to property acquired after November 4th, 2025, with a gradual phase-out starting in 2030. This incentive is significant because it provides immediate tax relief versus the 10% deduction that was previously granted. This improves cash flow and encourages businesses to invest in new or upgraded facilities, boosting competitiveness, supporting economic growth, and strengthening Canada's manufacturing sector, and once again, creating more jobs. There have also been some eliminations. The underused housing tax, the 1% tax on underutilized housing, will be eliminated starting in 2025. 2024 and prior years still are applicable. The luxury tax on certain aircraft and vessels also ends after November 4th, 2025. Budget 2025 also reaffirms some previously announced measures. Specifically, the lifetime capital gains exemption increasing to $1.25 million, and reporting requirements for bare trusts will be deferred until taxation years ending on or after December 31st, 2026. So deficits will remain high, projected at $78.3 billion in 2025-26. But the government plans to balance the operating budget by 2028-29. What they've done is they've changed the way that they budget. They'll now have two streams, one for capital expenditures, which they can borrow for. The second is the operating budget. This must have a balanced budget, meaning no deficits. With capital spending now separated from operating costs, future revenue measures may be needed, which could mean new taxes down the road to fund our operating expenditures. These changes create opportunities, but also challenges. Businesses should review their tax strategies now to stay ahead. For a detailed analysis, visit our website.